So, Matt, last time we spoke, you were positive and negative about the budget, but everyone else now seems to be negative about the budget. Do you want to update your thoughts?
Sure. So I'm still positive about the budget in that it's the first instance of meaningful reform for almost 20 years, more than 20 years. And so I like that they've attempted to tackle something difficult, in particular, the challenges Australia has around housing affordability. So I remain positive about that. Um, Part of my positivity was that in the past, when the government has announced policy proposals, they have been eventually more adaptive to feedback to ameliorate some of the more negative impacts of those policies or the unintended consequences of those policies to achieve better policy outcomes. So in the past, they've been adaptable. I'm not sure they are showing a willingness in the 3 weeks since the budget was handed down to accommodate much feedback at this stage. And so
Now
that's a
four
negative.
weeks, now 4 weeks
Now
actually,
4 weeks,
and
yes,
and
yeah.
I
So
think
it's
everybody is seeing the stubbornness. Can you give me some
yeah.
examples of where it it needs further thought? Because what seems to be coming through is that it wasn't the rollout of the budget wasn't planned very well.
Yes, so there are some blunt policy tools that they've sought to introduce to tackle tax minimisation from wealthier members of society. But because they're quite blunt, they also have quite a negative impact on lower income households that I don't necessarily think was thought through fully. So one example of that is the 30% minimum tax on real capital gains. That's a minimum tax. And so ultimately, the person who is most negatively impacted by that tax is going to be the person whose assessable income in that year is less than 45,000. That's the only time when a minimum 30% tax has a negative impact on the overall tax that you pay. So the government's thought process here, I think, was that people are using um, structures to preserve assets, or they're not realizing the exit of an asset until they're in a low income year to sort of tax plan their own circumstances. But the reality is, if you become unemployed because your job's been disrupted by AI and you have to self-fund your lifestyle expenses by selling shares, you're going to pay a higher rate of tax than someone who is on a disability pension, for instance, because you don't get the tax-free threshold. So it doesn't seem particularly fair. Um, and then another example would be the minimum 30% tax on testamentary trusts. So it's not clear that this will actually go through now. I think they've shown some restraint around legislating or pushing through legislation for trusts, but a testamentary trust is a trust established through someone's will. And one of the provisions of that trust is to protect orphans, for instance. And so having a minimum 30% trust tax from distributions potentially to an orphan, it means that the tax-free threshold is not available to the orphan, but it's available to you and me earning our incomes, and that doesn't seem particularly fair to me either.
Well, thank you for that. And central to it, of course, was that it's designed to make housing affordability more accessible to younger generations. Are you at least happy with that?
So I'm happy with the changes to negative gearing, and I'm happy with the capital gains tax changes to property. That those two things make a lot of sense and probably were late coming. I don't know if it was necessary to change the capital gains tax settings in the way they've done it to shares in particular. And the reason I don't think that was a good idea is that it introduces a form of double taxation in that when you allocate capital to a company, that company can generate earnings, and those earnings are first taxed at the company tax rate. And then if those um, retained earnings are reinvested in the company and increase the value of the company, you're then further taxed at the capital gains tax threshold. So that actually ends up sort of ignoring some of the indexation of cost basis. Just to put that to the side for a moment, you end up with a tax at a minimum of 51% because of that 30% minimum tax after the 30% company tax. So it ends up in quite a high tax rate. That's the minimum tax you'd pay as a share investor, or it'd be as high as up to 63%. And so if you're an investor looking to allocate capital and you can allocate it to shares or you can allocate it to property, the effective tax regime is actually much higher in shares than it is property. And so if the incentive here was to stop investors continuing to allocate money to property, which is typically held individually or through a basic unit trust, which doesn't have that double taxation regime, now the incentive structure is actually pushing more capital potentially back into properties, which is not ideal.
Right. So this smells of, at least to me, of not so much poor communication, but poor planning. And in the communication business, we look for a solid plan and then execute it with good communications. And it reminds, you've already reminded me in an offline conversation about what happened with superannuation, which was the changes were first proposed in February 2023, and it took over 2 years to sort that, what I'm going to call a mess, out. Do you see the
Yeah, I mean,
similarity?
I do. Um, I would think the initial changes that were proposed for super, which was introducing an unrealized tax on total balances, that the pitfalls of that were much more egregious than perhaps the pitfalls here. And yet it took 2 years to sort of amend the proposed policies to get to a better outcome that I think industry participants accept as reasonable. So my concern here is that the willingness to rush this through and also the political environment is much more favorable for the government to get this through. We may end up getting some poor tax outcomes. I mean, I think that the Ken Henry tax review actually proposed reducing the capital gains tax discount down from 50% to 40%. And I've seen other proposals that have said, well, maybe you introduce the holding period for shares from 12 months to 24 months before the discount applies. But most people acknowledge, because of the franking credit regime and that imputation credits don't go across to capital, that you need to have some sort of acknowledgement of the capital discount there to offset the double taxing impacts of share investing. So yes, will they change course? I don't know.
Well,
It's looking less
it's
optimistic.
once you get into the detail, it gets very confusing for lay people like me. But what I do sense is that they will not think that they've got 2 years to fix this.
No, I mean, if it takes them 2 years to fix this, they will have, made a big policy error. They're burning a lot of political capital on
Well,
this.
yeah, they're
I
going to
think
be
they've
in
got
a
other things
different,
they want to do as well.
whole different level of pain. Matt,
Yeah,
thank you very much.
pleasure. Nice to chat, Peter.